Hey all, in this video we'll go over trading the engulfing trader on the 15-minute chart. Okay, as you can see, I have two trade opportunities lined up right here. Now, how we trade this is very similar to what I showed you in part 3. We wait until price comes up to a daily resistance zone where we should have our alarm set. Then when it gets to this zone, we wait to see a bearish engulfing when it's a resistance zone in order to take a trade. Now, the 15-minute is a little bit different to the other time frames. Okay? On the 15-minute, what you want to do if you are using break even is you want to use your break even once you take your first position off. Okay? And I'll give you an example of that right here. Okay, so now this is the exception of the rule. And right, for all time frames below the 15-minute chart, you can use this as well. Right, so basically as your first position comes off, your other trade goes to break even. Right? So it's a little bit different. Okay, so let's check this out. Right, so this is your stop loss up here, right? This is your entry. You've got a nice bearish engulfing signal, right? See the signal engulfs the previous candles, telling us that the sellers are getting in. We enter here, the price goes down, right? This is where we take our first position off, so take profit 1. And our second position, we allow it to run until we get an opposing engulfing candle. So the first position, right, and this is where we lock in the other trade at break even as well. The second trade, like I said, we're taking two positions right here. And the second trade, it allows us to get 18 pips on the second trade. So almost a 1-to-1 on both the trades. First trade 1-to-1, second trade just a little bit less than a 1-to-1. Now you do exit the second one on a couple of pips above this candle, just in case it's a false engulfing signal and the price keeps going down. All right, so you exit about here for about 15 or 16 pips on the second trade. Okay, so it's 3/4 of a 1-to-1 in the second position with this signal. All right. Okay, let's look at the other signal. Price comes back up again to the daily resistance zone, and these are the lines that we draw in from the daily charts. Right, and if you're wondering what chart we're on, it doesn't really matter what pair you're trading, but this is the Euro AD. Okay, doesn't matter though. Works on all time frames and works on all pairs. It's just about identifying the proper signal at these areas that give a high probability trade. Okay, so let's get into this again. Now, I place the stop here. Now, the reason I place the stop up so high from the signal entry is because if you look left, this is where we're told to place the stop here. Right? So this is your entry. A 1-to-1 is here. This is where you take off position 1. It's also the previous low, just to the left here. Your other trade is locked in at break even once you get here. It's risk free. Right? You allow the other trade to run until you get an opposing candle where you believe you should be getting out. And in this case, price came down here. We got an opposing bullish engulfing candle. Price went higher, so you would exit about here. So this is basically a 1.5 on the second position. Risk to reward. You basically got 1.5 times the risk on the second position, taking it down to here. Yeah, about 28 pips, and you got 20 pips on the first position. Okay, almost 1.5 on the second position. This being the exit candle. Now, if you had held on a little bit longer, you know, this is where another exit candle, and so was this. All right. So let's go to the next signal. So after you exit these trades, you just set your alarms back up at this resistance zone, and you can walk away. Now you can set these alarms to go off on your phone, however way you want to do it. It doesn't matter. When this alarm goes off, you come and check the charts and see if you've got a trade. Very simple, yeah? Okay, so in this instance, we came back to this daily resistance zone again. Yeah? Got a nice little pin bar. Got an entry candle here. Right? So we enter here. Like so. Like I said, it could just be below it. It's not the same as the daily charts when you're trading lower time frames like this. Your stop loss, you already know where your stop loss should be. It should be about here. Look left. And your 1-to-1 is about here. But I'll confirm that. This is a risk of 25. This is a risk of 24.5. And there you go. So that's your 1-to-1. The other trade's locked in at break even. And as you can see, the price came back and tapped you out at break even on the second position. So you got a 1-to-1 on the first position, a break even on the second position. Okay, so then price came back to this resistance zone, touched it again, gave another sell signal here. Now this is a bit penny, so I'd recommend ignoring this signal, right? Price came down, price came up, didn't come back to the resistance zone exactly. You could have still taken this signal right here. It's still pretty close. It's not perfect, but it is a nice engulfing candle, right? Near the resistance zone. And what I mean by near the resistance zone, I'll just show you this. It's within 10 pips of the resistance zone, okay? It's very close. So this is a very valid place where you could be still selling, right? Of course, if you're still selling here, you have to place your stop above the area that the market has told you where you'd be definitely wrong, which is right here. Now, in this example, right, and this is a really nice looking engulfing candle, by the way. Price came up, gave a nice engulfing, and then it sold off. And that's a common thing when your price is coming up to test resistance. It'll eventually get exhausted, form a little bit of a lower high, close to the resistance zone, and then it'll just fall apart. It's finally the sellers have overcome the buyers, and then the price falls over. And this is a very common pattern, where it comes up and tests it strong, comes back up again, tests it strong again, and then comes up and tests it strong again the third time, and then it falls down. So when you get a signal 10 to 15 pips away from a resistance zone, don't be afraid to take it. All right, as long as the signal is a good, valid looking signal. Right, so this is the risk in this case, all right, which is, I'd say this is about 30 pips. Yeah, just over 30 pips. So we take our trade down to here, following our rules. Remember, this is a daily resistance zone, which is down to about here on the first position. Take profit 1. You lock in your first. You lock in your second trade. Just make sure that is to a 1-to-1 there. Actually, it's supposed to be a little bit lower. Just bear with me. Okay, so it should be about there. All right, let me zoom down so you can see that a little bit better. Okay, so you've taken that first position to a 1-to-1. The second position you allow to run until you get an opposing engulfing. Right, now all these signals, none of them are great. None of them are really significant engulfings. None, no, no. This candle's nice. So this would be a good exit candle. Right? Now, if you'd held on any longer, price really did sell off much further. Okay? But that doesn't necessarily always happen that way. So this is a valid place where you could have gotten out in the second position. Basically for a 2-to-1. We'll have a look at that though. 60 pips. Yeah. So if you closed a little bit high, it would have been about 57. You only want to close it if it breaks higher from that signal, which it did. It got out of 57. Okay, so nearly a 2-to-1 the second position. 33 pips on the first position. Really good. Okay, so that's an example of trading the engulfing trader on the 15-minute chart. So let me just go over this really quickly again. Wait for price to come up to the resistance zone. This is for sell. This is for sell buys. Wait for price to come up to the resistance zone. Look for a nice engulfing at that resistance zone. Place your stop above the resistance area, giving it a little bit of room, as can be seen here, and as can be seen here, the initial push of the resistance zone usually is the test that tells you exactly where to place your stop. Take trades down from there until you get on the second position, which you're allowing to run, till you get an opposing engulfing candle like this, or like this, or like this. You shouldn't exit the trade on the second position. Now this one was a break even on the second position, and this one got us a nice 2-to-1 where we exited down here. Right? And that's how you trade it on the 15-minute chart if you're selling. Okay, thanks for watching and happy trading. Here is an example of a buy trade on the 15-minute chart, trading the engulfing trader strategy. Okay, so let's begin. As you can see, the price came down to the daily support zone, gave a nice bullish engulfing at this zone area. Right, so that's your signal candle. This is a bearish candle before it. You can see it's bigger than it, so it's a nice qualified candle. The daily support zone, you place your stop below the signal. You enter a couple of pips above the signal. Right, this is just the 15-minute chart. Now with the 15-minute chart, we actually exit the first position at a 1-to-1, same as the daily. However, we don't actually use break even until we exit the first position on the second trade. So on the second trade, we do use break even, but only once the first position is taken off at the 1-to-1. Right? So price goes up from the daily support zone. The buyers get in, right, from here. We take off our first position here, take profit 1. The other trade, we allow it to run until we get a nice opposing candle telling us to get out, or we just simply allow it to run until it gives us a nice amount of pips. You just got to remember the second trade is a risk-free trade, and I highly encourage people to allow the second trade to run as long as you can handle. Right? The worst that can happen is it comes down and hits your break even on the second position, and as you've already taken off some of the profits, allowing to run, you can see that you could have gotten some major benefits. Now, as for exits, this could have been an exit candle, this could have been an exit candle, this could have been an exit candle, and even this could have been an exit candle. Allowing to run could have allowed you to get as much as 128 pips on this trade. Right? Just accepting that it could come back and hit your break even, or that it would go to the next structure point on the second trade. Like I said, you're already taken some of the profits off with a risk of 34 pips. Well, 33 pips, sorry. 33, 34. Yep. Right. So as you can see, this daily structure support zone worked once again. And this is an example of how you can trade on the 15-minute chart. Okay. Well, thanks for watching and happy trading. In this video, we'll go over an example on the 4-hour chart using the strategy. Okay, so to begin with, this is a daily support zone as identified from back here, right? All the way back here and all the way back even further, right? Now, when price came back down to here, gave a nice buy example right here. Nice bullish engulfing candle. Bigger than the previous candles and bigger than this previous bearish engulfing candle. So in this situation, for a buy trade, we would place our stop below the support zone, confirmed daily support zone, as you can see, looking left. You would enter after in the engulfing candle, right, like so, right, just a couple of pips, 4 or 5, in the direction of where you believe the market's going. You would lock in at break even at a body size. Let me just make sure that's about 35 pips. So you'd lock in at break even about here, right, on both the trades, about here, right, and then, so we can get rid of that now, that's a break even level. Like I said, break even's optional, but it's a good way of preserving and protecting capital, right? So as for your first trade, you take profit at a 1-to-1, so take profit 1, which is at a 1-to-1 risk reward, which is about here, right? The second position you allow to run until you get opposing engulfing candle, and as you can see, the trade would still be running. You could still allow the trade to keep running because we haven't gotten a significant bearish engulfing candle telling us to get out. So let's have a look at this. First trade, you're allowed to go to about 70 pips profit, 1-to-1. Your risk is about 70 pips as well. The second trade is still running and it's up 125 pips. Okay, so that's an example of a buy trade on the 4-hour chart. Thanks for watching. Hey all, in this video we'll be going over an example of a sell trade on the 4-hour chart using the engulfing trader strategy. Okay, so let's begin. Okay, first of all, this is a daily resistance zone, right? And price came up to this resistance zone where you would have been setting your alarms. We knew this was a resistance zone from the daily charts and had been drawn in from the past, as you can see back here at resistance. Now we'll get back to the price again. So we knew that most likely when it came back to this zone again, we'd get a bit of bearish price action. Okay, so what we're looking for is an engulfing candle in this zone, in this daily resistance zone, and we got one right here, right, which was a great entry candle, right? We enter after the engulfing candle, sell entry, but we enter 2 positions, right? The first position, and to begin with, let's go over the break even. The break even would have been set around here on this trade. Okay, if you're wondering what pair this is the GBP AED 4-hour chart, but it doesn't really matter what pair it is, right? As long as you're trading off these daily resistance zones with this time frame, right? And waiting for price to get to these daily resistance zones. Okay, so your break even would be around here, okay? And then, you would take your first profit off, meaning take your first position, like out of your 2 trades. Your first trade, you would take profit 1 right here. The second trade, you would allow to run, and this could be a possible exit candle. So would this, or even if you held on a little bit longer, this one, or even this one. Like I said in previous videos, I encourage you to let your trades run as long as possible. This isn't the daily chart, right? And when it's not the daily chart, I encourage you to let your trade run, because remember, these are daily resistance zones, okay? And sometimes, you might want to take your profit a little bit early, like going off the rules, like as an example, getting out here or here. However, by allowing to run on some of your positions, you can get major rewards such as down here and down here. Now let's look at that from that perspective for a moment, right? And you've got to remember these are daily resistance. Let's just go over this one more time. These are daily resistance zones. So there's usually a major bounce from these areas of at least 100 pips or more, right? Now, if you want to understand a little bit more about daily resistance, I'll just sum it up in a nutshell, right? They work about 70% of the time for a bounce of at least 50, usually at least 50 to 60 pips, right? However, when they work, on a major scale, they go a lot further than that, right? Now that figure isn't exactly 50 to 60 pips on the larger scale, but with the edge of using these major resistance lines, it gives us a high probability trade with our engulfing candle signals. All right. So let's get into it. So what was the possible reward on the second trade? Could have been down to here, which is 300 pips. All right. If we'd held on a little bit longer, it could have been down to here, which is 400 pips. If we'd even held on a little bit longer, it could have been 666 pips. And if we'd held on even longer, for a final place where we would consider taking an exit, 812 pips. Well, exit a bit above, so just under 800 pips. So these were all possible exit candles. See this engulfing candle here, engulfing candle here, engulfing candle here, and this was a fine exit place as well, right? Abiding by the rules, 288 pips, more than a 1-to-1, right? However, if you allowed it to run, you could have easily gotten more than a 2-to-1 on this position, right? Okay, well, thanks for watching. That's an example of a sell trade on the 4-hour chart. Thanks for watching, and happy trading. This is an example of a buy trade on the engulfing trader on the 1-hour chart. And if you're wondering what pair this is the Euro US. However, it doesn't really matter what pair it is, as long as you're looking for these daily support zone structures and just trading in these zones. Okay, so this is a confirmed daily support zone off the daily, right here. And as you can see, price came down to it, bounced off it initially to begin with, and we'd be looking in this zone for a bullish engulfing candle in order to trade. Okay, so let me mark in the signals that I can see right here. First of all, we got a nice pin bar with a bullish engulfing body, bigger than the previous candle body. Yep. Then we also got another bullish engulfing right here. So we had two valid entry points from this support zone. One here or one here. Each one is fine. So let me get rid of this one now, and we'll just take the first signal. It's nice and clear. Now, if you get an engulfing candle, which is also a pin bar, that is fine. They're great. They work really great. Okay, so you place, you enter after the market here, and you place your stop below the daily support zone, which was confirmed right here, if you look left. Right? And so what you do is you want to take your first position off. Let's have a look at the risk first. 35 pips, so not a big risk. The first position off at 35 pips, which is right here. Now you're probably wondering where to take off break even, where to use break even, right? Well, this is an interesting candle, right? Because it's a pin bar, right? So the body size is quite small. So what you would do is you just grab the body size like this, which is about 12 pips, and just add on a little bit more pips because it's so small. Now, when the body size is really, really small, you've got to add on more pips. And this is just a 12 pip body size. So in this instance, let's round it up to 20 pips for a break even for both the trades, which would mean we would go to break even So let's have a look at this. 20 pips on this candle would be down to about here, right? Just because the lock-in at break-even is too small, all right, for using the body size. And because Euro-US is not usually a very volatile pair. So we have to round up for the break-even. Right, so let's move on. So we decide to lock in at break-even around 20 pips. And I recommend that if the break-even is too small, right, on the 1 hour, right, it's okay to lock in at like 12, 13 pips on the 15 minute sometimes. But on the 1 hour, if it's too small, I would recommend adding it up, like taking it up to the 20 pip break-even level, right? Just so you're allowing the market to move, rounding it up, all right? If you know what I'm saying? Yeah. So both positions will be risk-free around here. You got to remember this is a daily structure support zone. Very highly probable that it's going to go up from here, at least for a short-term bounce. So you'd lock them both at break-even around here. Right? Basically just after this next candle opened. Okay. So, and what you'll find is if you use a tiny break even like that, of like 12 pips, it's very likely that the price might pull back and actually hit your break even. Okay. We know that price didn't come back and hit our break even here. In this example. 20 pips is a very low break-even point, right? And we just rounded up, like this is like a 12, 13 pip body. We just rounded up because it was just too small. Okay, so moving on. This is the 1-to-1 for taking profit. The next position we allowed to run until we got an opposing candle telling us to get out. And look, we got one right here, almost straight away, right? Opposing engulfing candle. Now I'll pinpoint that. However, you could have allowed the market to keep moving. Like I said, it's highly beneficial to allow your second position to move, try and get some more pips. Remember, it's risk-free, the second position. And this was also a sort of like a fake bearish candle. Now, I mean, the worst thing that can happen is the second position, it comes down and it hits your break even. Right? So let's look at this in summary. If we got out there, 34 pips on the first position, and if we got out here, we'd get about 30 pips on the second position. If we allowed to run, it could go much higher. Right? Yep. Waiting for an opposing candle up here. And just accepting the fact that it could come down and hit your break even. That's the beauty of opening up two positions and allowing your second trade to run. Right? However, if you just want to follow the rules of just getting out the first bearish engulfing candle or the first opposing engulfing candle, then that's fine as well. And you can just sometimes allow it to run and allow it to run longer, just accepting that it come back to break even. And other times you can just, get out the first big opposing engulfing candle. But if you're wanting to get like 4, 5, 6-to-1s, you do have to allow it to run sometimes. Okay, well that's an example of a buy trade on the 1 hour chart. Thanks for watching and happy trading. In this example, we'll give you an example of how to trade the engulfing trader strategy on the 1 hour chart. Okay, so let's begin. This is a sell opportunity, right? Okay, first of all, this is the daily resistance zone as we're drawn in from the daily chart, right? Price came back up to this zone, right? As you can see, price came up to this level. This is identified in the past, way back in the past, right? And so when price came back up here, we knew that if we got a nice engulfing candle signal in this zone, such as this one or this one, we'd have a great trade opportunity. Now let's just look at it from this signal. This is a valid signal here to the left as well. So you enter after. Now, as it's not the daily chart, you can just enter a couple of pips below. right, like so. So that's your entry. Your stop loss would go above the previous signal, giving it, and also a little bit above, just to give it a little bit of room, right? Which is, in this case, just over basically 31 pips. All right. Now, as you remember, we lock in at break even around the body risk size, which is this candle. So we lock in at break even around, basically around 15 pips. You round up. It's 14.5, so round up to 15 pips. So we lock in at break even around here on both the trades. Now, like I've said before in the past, in this series, break even is optional. You don't have to use it. Break even is just a way of preserving capital. So, okay, so at the entry point, we'd entered 2 sell positions where we could lock in around here, around this candle. Okay? Now, for the first position, we'd like to take off at a 1-to-1, which is about here. Right? So take profit 1. The next trade we allow to run, okay, until we feel comfortable with an opposing candle signal telling us to get out. And just remember, the second position is risk-free, so allowing to run as long as possible is preferable. So as the market moves down lower, right? We had a candle here which, it's not bigger than this previous candle, so we can ignore it. Keep moving down here, moving down here, moving down here, moving down here, until we actually got a decent candle. Bigger than this previous candle, bigger than this previous candle. Telling us that we could exit right here. Now let me just zoom out a bit so we can see a little bit more in detail. That's the candle that we could possibly exit on. Now what would this mean? The entry was here. The reward was just over 30 pips, 31 pips to be exact. And this one, exiting here, allowed us to get 80 pips from the market just by allowing it to run. That's more than a 2-to-1 on this trade. Okay? It's almost a 3-to-1. 1-to-1 here, almost a 3-to-1 on the second trade, allowing it to run. And like I said, it's highly, recommended to allow the trade to run as long as possible as you can handle on the second trade. Because remember, it is risk-free, it's locked in at break even. The worst that can happen is all of a sudden a really strong candle came up and flicked up and hit your break even somehow. Right? And that does happen sometimes when the market just completely turns around and comes up and hits your break even. But just remember, you've already taken off one position, and by allowing to run, it can give these great rewards, as you can see here. Basically a 3-to-1. And as you can see, the price even moved along a little bit further and then even fell even more. This is a daily resistance zone. Alright. Well, that's an example of it on the of a sell trade with this strategy. Thanks for watching and happy trading.